Hi everyone, welcome to ELI, the place where you get your daily dose of inspiration for entrepreneurship. And today we have with us Miss Jaya Vaidhyanathan, who is the CEO of BCT Digital, which is the Fintech wing of Bahwan CyberTek, working in the areas of risk management for banks. Jaya also serves as director in multiple BFSI entities such as UTI Mutual Funds, India Group Trust, and PricewaterhouseCoopers. Hi, Jaya. Welcome to ELI.
Thank you. It's a pleasure to be here, Priya.
I would request you to introduce yourself to our audience.
Thank you. So I'm Jaya Vaidhyanathan, and I am an entrepreneur, and I run two distinct segments of business that works with the risk and compliance space. And one is in the area of Fintech, where we work with a lot of financial institutions and have products tailored for the financial institutions. The second area is where we work with energy and utilities and clean technology companies. All our technologies are propelled by artificial intelligence, predictive analytics, and they serve the risk and compliance space. So by way of introduction, I did start with an undergrad in computer engineering, and then moved on to do an MBA in strategy and finance from Cornell, and also did a CFA. I'm a CFA charter holder. Started my career with investment banking, focusing on mergers and acquisitions and IPOs, and then moved on to HCL, and then moved on to management consulting, and then went back to bank, and then decided that I would combine all my experience and contribute to the entrepreneurial capital of India, and then moved back to India, and that's my story.
Awesome. Now tell us a bit about BCT Digital. What are the different services that we provide, and who are the customer base, some of our notable kinds?
Sure. So we started our journey by focusing on products catering to financial institutions. So it originally started with banks in India, and pretty much most public sector banks our customer segment. And then we also operate out of 20 plus countries. So as a company, we are present in the Middle East and in the US and parts of Far East, etc. So the second area of business is a bit newer, which is more focusing on clean technology companies, which essentially means a lot of predictive analytics, a lot of artificial intelligence, figuring out when plants are going to fail, and looking at renewable energy with a lot of cool things such as drone image integration, etc. Taking data from which solar panel needs to be replaced, getting into areas that are flood affected, and looking at when are they going to be up again. So things like that is something that we work on. So you would look at it in terms of business function. If you look at financial institutions, we focus a lot on the credit and operational risk management side, and we focus on compliance with the payback. As in, not only do we meet your compliance needs, but we also save you money in the process. So that is something that's been our tagline, and that goes on and extrapolates also the clean technology companies that we serve. So governance, risk compliance, early warning systems, model risk management, all of these are something that we are very, very well known for.
So for some of the uninitiated to relate to the business you are doing, can you give us some examples of how you have helps of banks do compliance or save money by doing better risk assessment?
Sure, we can look at an example of, say, a bank with an asset size of $50 billion, right? So you have non-performing assets, which are a major thing in today's world.
True.
So that is nothing but taxpayer money. That's your and my money, which is essentially what we gave to the banks as custodian of our trust. And out of the 50 billion, 5 billion are non-performing assets, let's say,
Okay.
And then what happens is that they have an early warning system in place. Even if they reduce their NPA by 1%, right, of the $5 billion, you would look at a considerable amount of millions of dollars being plowed back to the economy. That is something that will be used for us on a day-to-day basis back to taxpayer or back to the bank. It's as simple as that. Now,
Okay.
early warning system does sound complicated for people not from fintech. So let me make it very simple.
Yeah.
Nowadays, you hear a lot of people saying he was perfectly healthy and he died of a heart attack. So that doesn't happen. So before a heart attack happens, there are a lot of early signals that your body sends, which includes, say, like your pulse parameter or the buildup of cholesterol, your arteries kind of being blocked. So these would give symptoms, like when you walk, you get breathless. When you kind of do your checkup, you would find that you have high cholesterol. You could or could not have high BP as a combination of things. All of these are something that the body has early warning symptoms before it actually gives you a heart attack. So what you need to do is work on the phase where you control those parameters to prevent a heart attack. This is very intuitive, simple. Extrapolate that to the financial services system. Now, for instance, Vijay Mallya didn't go from being a great customer to a really bad customer overnight. There was a lot of stress in the portfolio, incipient stress in the portfolio. There were parameters when checks were bounced, where there were parameters when there were things that showed apparently a lot of stress. There was like a lot of media news that, there were audits. There's a whole lot of things going on. So our focus as a system or as a product is to say we don't do services, we do products. The products focus on capturing that early symptoms or early warning signals that tell you that these are things you can do from a preventive perspective rather than a forensic perspective. So forensic perspective is after an incident has happened, it goes into collections, it goes into litigation. So our focus is on after you've onboarded a customer and by the time he's in your system, there are a lot of things that happen in the system. So how do you track those early signals and how do you work on it and prevent it from going into a stress? That is the example of one product with an example. How do you look at it? Now in the traditional banking world, you only had a few systems, like you would have your core banking system, which gives you customer data. You would have loan origination system that tracks how the loan is originated. Why did you give a loan? Now, what is the payment pattern, etc. But in the traditional sense, there was limited availability of technology. Like you have the big data sources. Now, let's say you're looking to track a third-party diversion of funds. So you want to know, is this a genuine party or something is happening? And if you kind of do it real time, what will happen is that after the money is already credited to a beneficiary, you can't go, you have to go take it through litigation, collections, whole bunch of stuff. But as soon as a beneficiary is set up, if you can kind of go into the big data realm and kind of figure out whether the beneficiary is one of the blacklisted companies, is the beneficiary been in the management audit frequently? Are the directors of a company that's blacklisted? Have the directors been dumping shares? So, I mean, I'm just giving you a few indicators, but we get up to 3,000 data points on a particular person. And then our AI engine would kick up along with risk algorithms and tell you with a lot of quantitative scoring. There's a lot of mathematics behind it. It'll come back and tell you with 86.3% probability, this is indeed a fraudulent account. Stop the transaction from happening. So imagine that the power that it puts back into your hands. And for instance, I remember reading in the paper, Union Bank commented saying that early warning system has given them significant savings beyond what they budgeted for. And that is an example of how this is being used.
Awesome.
So in the areas we play, we have a 92% win ratio. We have a first mover advantage. We started it way before it became even a guideline from an RBI perspective. So there's a lot of work that goes on.
Okay. What is the actionability of, just curious, let's say you give an early warning that some person will default in their loan payment, and you notify the bank. How do the banks react to that? How do they make sure that they do not default? What is the actionability part of that?
It's actually very, very simple. It's actually less complicated than even what you phrased, because what happens is that it's not that saying you have early warning and just work on it. The early warning gets triggered through a workflow process. It goes to multiple people that have to look at it and authorize it. It'll also have a library of corrective action plans. For instance, if you know a corporate is not doing well, see now, let's flip back a little bit to make this understood. So when a bank, I'm just using one, we have multiple product suites. I'm just extrapolating what I explained earlier so that it's more clearer. So loan defaults can happen because of two things. One is the willingness to pay. The second is the ability to pay. What is willingness? If you have money and you don't do, which is the loan frauds. The second is because of the ability to pay, which could be because of stress. Let's say because of COVID, for instance, the business had a setback and you know there's going to be a problem. Or like, for instance, during COVID, the tourism segment was something that was really bad. And everybody predicted whether it's going to be a J curve, it's going to be a K curve, how is that going to happen? So there's a lot of things that go in. And we know that there were fundamental factors that affected the industry, and there is a different way to address it. So as a bank, if I had a lot of exposure to tourism industry, I know what percentage of my portfolio is going to be against stress. So that I will cover differently. I may ask for more collaterals. I may ask for more things. So there will be a library of action that says, look at the covenants, rejig it, ask for, a lot of different factors that can stem that. The second is the area of loan fraud. So that is dealt with very severely. And for that is what you talk about, like the beneficiary. How do you stop a transaction from happening? How do you kind of figure out how the pattern is? Are they continuously doing this willfully? So both of them are very different and they are addressed differently. The ability to pay, we look at modeling industry factors. We would look at kind of giving lead indicators to say the steel industry is going to be stressed vis-a-vis something else, and this is going to be a boom. So there's a lot of, it's not as simple as saying, I say because there's a trigger. There's a lot of quant modeling that goes into it, a lot of science, a lot of math that goes behind it. And that will not only tell you there's going to be a trigger, it also monitors it on a continuous basis. It tells you what are the kind of things you could do and puts the power back into the banker. But at the same time, it also has accountability in terms of who's working on it, an audit trail, whole bunch of things, right? So it's a big heavy duty return to taxpayer money. And that's something that I'm just explaining it to you simply in layman's terms. It does not just flag alerts, it tells you also potential actions you could take. And in fact, certain cases, it may even insist that you do ABC action. So it all depends on how that's set up. So when you look at from a regulatory angle perspective, RBI has defined certain alerts that banks must have. They've defined the minimum number of alerts NBFCs must have. They've also, not only the RBI, but Department of Financial Services has come up with some additional things that you must monitor. And that will be a subset of what the bank does, because bank will have custom alerts as well. So you're not talking about one or two, you're talking of hundreds of alerts and on, a whole range of customers that goes on. It could be corporate, it could be retail, it could be, your MSMEs, it could be agri, it could be a variety of things.
Okay. Speaking of data analytics, you mentioned that your engine collects around 3,000 data points for every individual who might become a bank's customer.
Number. I mean, it's not, it could be 5,000 depending on number of hits you get. Yeah.
Okay. So just curious to know, what are such data? What are the sources of that data? How do you gather the data? In fact, a lot of fintechs these days gather data from the mobile devices of the customer, things like the transactional SMS, and also curious to know how on a broader level, if it is a broader banking group, how does a banking system collect data and what are the data sources?
Yeah, so that's a very interesting question. The answer, it depends. It depends on which country you operate in and how that goes. So since we're looking at a broader agenda in terms of scalability, there are data privacy kind of rules in different countries, right? So there is a GDPR, Europe deals with data privacy differently from Middle East, and then compared to India and the US. So each of that has to be, our products will regulatorily comply with local country regulations. So that is a generic statement. So what that data is will differ and the data source will differ. Okay. For instance, like ROC gives data here. In the US, you could get it from 10Ks filed, and that's like a separate repository. So the fundamental engine is the same for all countries, but the data it taps and the sources it taps varies by the country. Now let's flip back a little bit to India,
Yeah.
right? There is a domain of publicly available information that anybody can access, which would include like corporate actions. If directors dump shares, I gave you that as an example. There's frequent change of directors at the top. These are all publicly available news. And then you would have management audit and things like that. Those are again publicly available news. You get a lot of news, you get a lot of web hits, you go to anything that's a public domain as such and collect a whole bunch of data. Then other than that, there are other sources of data, not just the web crawl. For instance, credit bureau. The bank would have subscribed to multiple credit bureaus. It could be like an Experian kind of a thing, oriented data that operates out of information like that, or a CRIF Highmark, or different agencies such as that operate in the realm. So they will have even, example of some credit bureau information that will not be available to the public would be, let's say that, Priya, did you have pledged the same collateral with multiple banks, as an example. So that is something that only a credit bureau can pick up some of those data. So the subscription that the bank would be integrated to our, and we would take APIs from even that kind of a data, as an example. Third would be what we call, data can be segmented as such. One would be unstructured data, which is kind of some of that big data, alternate universe. How do you kind of go there and get the data? The second component will be structured data, which is what the bank's own systems have, right? Which is your loan origination, core banking. So this system sits on top of it, has APIs or connectors to both structured data, unstructured data. Then you could have a lot of flat files. Like a bank collects bunch of documentation, and it's not correlated to anything else. So we would kind of use OCR recognition and pick up data. For instance, it's a retail company and there's a lot of stock pile up, as an example. So that data is resident on a flat file, as in like a, piece of paper. So that would be taken from an OCR recognition, sucked up into the data, and that would be married with the rest of the data to see if there are any anomalies. So when you say data, it's not one data, it's different forms of data, and it's making sense out of the madness of those kind of different data and see if there are anomalies. Let's say, as Priya, I asked you a question, and the question was worded different 3 ways, and you gave me completely different answers. Then I would know it's an anomaly, right? So that is what happens in a court. They ask you the same questions in 3 different ways, and if you say 3 different answers, then they would know you're not. There's an anomaly. Same thing, you would have unstructured data, the structured data, and other forms of data that is there. And all of them need to be consistent and say the same story. Those are things that you pick up.
Got you. We have discussed about the problem statement. We have discussed about the products and services you offer. Now would be very curious to know what is the business side of the entity you run. How does your venture make money? What is the revenue streams and what is the business model?
See, we've been one of those companies that have been profitable. It's been run something. Most these days, you hear a lot of fintechs that have raised money but are not really profitable. That was never a model. We were kind of like we reuse investment. We're kind of like profitable. Our EBITDA is good. So I would say that we finance our own scale-ups in a sense, right? So it's been a profitable business. The business model, if you're asking, it's both on-prem and SaaS. We operate out of both models. And that comes with a lot of regulatory push in different regions. For instance, in public sector banks in India, they would prefer an on-prem rather than a cloud-based product. So we offer you both a hybrid model. We give you a on-prem. We also do with SaaS models. So we operate out of multiple models, and we operate out of multiple countries, like I said. And we follow the regulatory cycle in terms of scale up. For instance, I just mentioned one product. I'll break through the journey and talk about other different products. Like, for instance, the early warning system is a banking product. It was a mandatory spend as far as India goes, because we had a lot of NPAs, we had a lot of PCA banks, and RBI said, unless you have an early warning system in place, no additional funding. But that NPAs became a huge problem in some other countries
Mm.
post-COVID because there were a lot of non-performing assets. And therefore, the regulation kind of followed. So what was in India is kind of something that, for instance, Australian government, the APRA came up with a guideline on credit monitoring.
Mm.
So that is kind of like a push area now in the Europe, and it's a big push area in like tier 2 banks, for instance, in the US. So we
Mm.
follow the cycle and kind of do it for that. I'll give you other example. We'll get into ESG. It's a big area in which we play.
Mm.
Now, if you look at ESG, there are different components of ESG. People are just talking about it, but it's kind of a mandatory requirement in UK.
Mm.
And Europe is well advanced compared to India as far as ESG compliance goes. But
Mm.
India can't be far behind because unless you're an approved vendor that follows ESG norms, you can't trade with a lot of regions that are in fact ESG compliant on a mandatory basis.
Mm.
So there are, again, if I segment ESG for you, one is what ESG does with respect to data. Second is where a lot of consulting firms operate, which is in the area of frameworks, guidelines, policies, metrics for
Mm.
ESG compliance. The
Okay.
third area is in the area of climate-related stress tests. What do you do? Let's say there's a war. We had Russia and Ukraine war,
Yeah.
and there was an impact in terms of fuel and who could trade, economic sanctions, and all of that.
Mm.
So what will be that impact in a lot of quant crunching? We are quant jobs. We are really good with math.
Mm.
So that component of automation of the math is something that we do really well. And the fourth component is financial reporting with respect to ESG.
Mm.
On that platform, we do a whole lot of things that gives you the data required for financial reporting. So
Okay.
that is the framework in which we operate. As a business, if you look at it, as an since it's an entrepreneurial lounge, I want to focus on the building of the business as such.
Yeah.
So we spend a lot of time pre-launch of a product on strategy.
Mm.
And the strategy is very simply find adjacency left by the big players in the market. So we don't to head to toe compete with products that are already doing well in a market and have a name in it. But most of these tech players in a specific, let's say in a bank or in terms of energy, give a platform and they say, build your solution on it. We don't do that. We come up and say, here is a business solution to your problem. And here are some white spaces which are going to be big impact, and you're going to lose a lot of money if you don't spend in these areas. And we come up and spend that, looking for adjacencies in the market, looking for those white spaces where, others are not there, and building a product to that particular solution is something that's a core capability. And that is something that we work a lot on. And that is something that, I would say is a core strength. So once you've developed a product and got the first few customers built out, and it's also, I think the second core strength would be looking at scalability across markets.
Okay.
What is the product going to be single market, single product, or is that going to be something that's a single product, multiple markets? That's very, very important from a scalability perspective. So any we do a product, we are looking at build local, go global is something that's a mantra. So build a product, it could be in India, but look at its applicability globally, and what is the time frame, what's the strategy, and how do we do that? That's a very important component of what we do. Third is looking at spending less, but at the same time looking at global capability, which comes from looking at good channel partners in the region. Are they single vendor kind of saleable kind of commodities, or are we looking at channel partners for multiple regions? So the entire thought through from production all the way to how it reaches a client and in what format is something that we do spend a lot of time. Not just create a product and then figure out who's going to take it, right? That's a different mindset. And that comes from a very strong investment banking and consulting mindset of the people that work with us, besides the hardcore product technology roadmap mindset.
Okay.
It's not like who's going to buy, but we look at what's the market need, what is the business need, what is the applicability across countries, what's going to be the scale up, and then kind of see whether this product makes sense.
My next question is around organization building. Since you have built organizations, and you have been also in the leadership roles of, or other orgs in the as independent directors and as consultants as well. Uh, I would love to know what would you say is the right way to build a entity, especially in the BFSI space. How do you build a org?
I think there's multiple dimensions to it. I explained in my previous question about how to build the business. How do you spend more time thinking than doing, at
Mm,
least the beginning, and always look at whether the product still continues to meet a need. If
mhm,
you need to exit and it doesn't make sense, or make the call earlier, which is something that I would advise. I think building a team is really important and relevant to your business.
mm,
And that comes from when you're looking at, I'm not recruiting employees, I'm recruiting a team. That's a very different mindset. These are the guys that are going to be with me for the journey. And it's important that they share the vision of what we're trying to build. They believe in what we are going to build and are part of this entire journey.
mhm,
While the great resignation was happening all around us last year, we had a very low attrition rate. Because I believe they're in here to build that dream and to build that vision and to look at what the end result is going to be and how are they going to be participatory in that journey. So I think there's a fundamental difference between recruiting employees and recruiting a team of co-workers who are going to kind of be your, founding figures of the journey ahead. So I think that's a different mindset when it comes to employees. And study, 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 work a lot on analysis, figure out what product does it, like I said, white spaces, adjacencies,
mm.
scalability across markets, all of that is really, really important.
Gotcha. My final question, during your journey as an entrepreneur and as a leader for your organization, what did you say is the most interesting lesson that you have learned, which can be taken away by other entrepreneurs and applied to their ventures as well?
I think I would kind of like put it in like 4 words,
Yeah.
not even a sentence. I would say plan really well, which is the core to the success, which means all your planning includes your due diligence, planning includes, right market, right space, what is the problem you're trying to solve.
Mm,
Second would be prioritize. Prioritize, you will have a million things that come up. So segment that and say, this is my 1, 2, 3.
mm,
Prioritize. And once even you plan, you do that and you start building your product, there are going to be days when you're kind of figuring out, what the hell am I doing? So I
mm.
would say third one is plow through.
Okay.
When the challenges come through and you have a vision ahead, plow through,
Mm.
right? And persevere in that journey. Because at the end of that long and arduous journey, you will see the rainbow at the end of the corner. So it's all peace for you.
Yeah.
Plan, prioritize, plow through, and persevere.
I think a lot of fintech entrepreneurs emphasize on planning because the margin for error is very less in fintech and finance world. On this note, I would like to close the session. Thanks for your time, Jaya, and it was a great pleasure to have you on our platform.
It was a great pleasure talking to you, Priya, and we'll be engaged. Thank you.
Thank you.